Hey everyone, what a year! As a dividend investor, this has been an extraordinary year. We started out all right, this pandemic hit, and then in March things plummeted, and now more or less the types of stocks that I buy, world-class dividend stocks, they have fully rebounded to their prior levels, even though the economy overall is a little bit shaky right now. And so with this backdrop, I received a question recently from one of my friends, one of my generous sponsors on Patreon, that I wanted to answer today. But I like his question because it is part of a broader question that I receive from so many different investors here in the community. And the question is one of doubt and regret. There are so many investors in this community, dividend investors, who think, hey, Ian, is it too late? Is it too late for me to be successful in the stock market? Or, hey, Ian, I have made all of these mistakes in the past. I've made these mistakes, these investing mistakes. I've lost money. I regret making these investing mistakes. How do I move forward from that? Ian, the stock market has recovered. It's already recovered. I missed out on the lows in March, or even worse, when things were tanking in March, I sold off some of my dividend stocks thinking that it was going to go even lower. And you know what, Ian? It's rebounded from here. What do I do? How do I get past all of this? Well, first and foremost, I don't offer financial advice here. I don't comment on any one specific situation. But what I do want to do is, this is such a universal concept and question that I want to answer it hypothetically through myself. I just want to put myself hypothetically, hey, I've made all these mistakes. How do I get back from that? How do I move forward from that? How do I get on track for successful long-term dividend investing? And quite frankly, this isn't so much of a hypothetical, because in my early days, if you've been here on my channel for a while, I shared a video a long time ago. I'll link to it in the description below, about my top investing mistakes. I have made every investing mistake in the book, but I have learned from them, and I've evolved and become a better investor over the years. Thankfully, I made a lot of those mistakes early on, and I've just been at the game so long, I've been so persistent, that those are long in the past. But we all make those mistakes, we all grow from them and learn from them. That is part of the investing journey. And so in a really exciting fashion, I'm going to be sharing two of my dividend stocks today to basically answer this question and illustrate so many insights that I have personally learned through investing in two different stocks right now during 2020, during the pandemic. And the two stocks that I'm going to cover today are PepsiCo, ticker symbol PEP. This is an amazing dividend stock. I just covered it in my last video, which I'll link to in the description below. My top 12 favorite dividend stocks of all time. As I shared in the last video, they make this really cool beverage called Izzy. So it's not just about Pepsi Cola, but PepsiCo makes so many other beverages. And most importantly, they are behind the Frito-Lay snacks and potato chips. But anyways, I've been buying that stock recently, and what's so interesting is I had been on a really long leave of absence, if you will, in between buying PepsiCo. It had been a while, and so I'm excited to be buying it again. I want to talk about PepsiCo today because it sheds a lot of light on this very question, this very dilemma that many investors face, and I want to talk about Starbucks today. I want to talk about Starbucks. I know I talk about it a lot, but again, there are so many lessons to learn through Starbucks, especially right now in 2020, because I'm getting all kinds of questions. Hey, Ian, people are at home right now. They're at home. And you know what, Ian? A lot of people are not drinking Starbucks every day. Hey, I'm guilty too. I've been drinking the Kirkland cold brew coffee right here. This is good stuff, everyone. This is good stuff from Costco. And I'll tell, oh my God, this is good stuff. I really like it. But anyways, people are thinking, Ian, Starbucks earnings are down. They don't cover the dividend right now. Are they going to cut the dividend? Get this question on Twitter basically every week. I want to talk about that and how that plays into answering this very question about doubts. Is it too late? Are the stocks overvalued? Anyone buying stocks right now, myself included, are we buying the absolute top of the market and a year later we're going to regret it for the rest of our lives? Get ready, everyone, for an exciting dividend investing video. All right, everyone. So PepsiCo. I want to start with PepsiCo. I'm going to share some statistics on the screen right now. And what you're going to see is my purchase history with Pepsi. And one of the things that I find as a dividend investor, a long-term dividend investor, that I like doing is I like just mapping out data. I like looking at data in Excel because it helps me answer questions. It helps me even come up with questions that I should be asking myself as an investor. And when I started mapping out this data in preparation for the video today, I found some really cool insights. So what you see right now is my purchase history on PepsiCo. Now, this does not include reinvested dividends. It just includes net new capital added. Reinvested dividends are not shown here to keep things simple because that would add a lot more trades on here as well. And one of the things I want to show you here is basically my PepsiCo purchase history. Now, the first thing I'll tell you, why did I start with my purchases in 2018? I'll tell you why. In 2018, I did a video, and the video actually, at the time I was buying PepsiCo, it wasn't on sale. When I was buying PepsiCo, people in the community were asking me, Ian, isn't this richly valued? Aren't you going to wait for it to drop? Why are you buying it here? The reason I'm showing this off the bat is right now PepsiCo is trading at $136.01. But back when I was buying in 2018, when people thought, hey, it might be overvalued, hey, you might not be buying at the right time, I was buying between $96.97 and all the way up by the end of 2018 at $108.59. And I was deploying a good amount of money into PepsiCo back there in 2018. And so the first takeaway here is it is so interesting when you're in the moment as an investor with high quality stocks like PepsiCo. Oftentimes it feels, and people echoed this sentiment at the time, like, hey, you're paying too much. Hey, it's overvalued. But you fast forward just a few years into the future, just 2 years into the future, and you can see that it is already appreciated from that $96 to $111 range or so, all the way up to $136. And so first and foremost, as a long-term investor, even if my high-quality stock like PepsiCo seems fully valued or even a little overvalued, I oftentimes take comfort that the long-term trend is up and to the right, especially because I have time on my side and I am a long-term investor. But I want to get back to the data now, look at it a little bit more. And so what you see here is I keep buying, and I bought some more in 2019 at 108, 115, 121. But what was so interesting, so interesting is for whatever reason, I stopped buying. And so I have a column here that says days since last purchase. And what you see here is I bought shares on March 26th of 2019 at 121.77. Fast forward, my next major purchase, other than reinvesting dividends, was on 6/17, so June 17th of 2020. And I missed the March dip. I missed it. I was too busy buying other stocks in my portfolio. I only had so much capital to go around. And so at the time, I wanted to buy PepsiCo in the March dip, but I was focused on other stocks like Starbucks, which you'll see in a moment. But anyways, I bought in June of this year, and I bought at $132.82. And by the way, before this month of July is over, I am going to hopefully pick up some more shares of PepsiCo, being my number 2 favorite stock of all time. One of the things that this simple analysis showed me is I don't want this to repeat itself. I don't want history to repeat itself. I highlight a cell on the screen right now that you can see 449 days passed between my last 2019 purchase and my first 2020 purchase. How is that possible when this is my number 2 favorite dividend stock of all time? I'll tell you, one is I own 46 stocks, and so I probably got a little bit distracted. I probably got a little bit distracted just looking at the portfolio holistically. But also, this is a new metric I'm looking at. This is a new metric. And one of the things I really want to hold myself accountable for, especially for my ride or die stocks, my favorite stocks like PepsiCo, is how many days have elapsed since I last bought the thing. And here I see a major revelation that I did not buy this thing for over a year of time, and it gets even worse. This is underallocated in my portfolio. PepsiCo is a stock in my portfolio that is not at target allocation. I need to allocate more money to it. I want it to get bigger, and so I need to stay persistent. I need to stay focused. And especially, I'll tell you, the starting dividend yield right now is 3%, 3.01. That is a reasonable starting yield. Now, the starting PE ratio, it's fully valued, if not overvalued. We talk about that in my last video, which I'll link to in the description below. But the fact of the matter is the starting yield is just fine. And so there is no reason right now, no good excuse, no reason that I should not be buying PepsiCo. And so again, in July, before the month is over, I will probably buy more. And certainly this is going to be one of those stocks in August that is going to be on my list as well. And so this analysis was so interesting to see that. Now, something else I want to point out in this table is my simple yield on cost. Obviously, if I look back in time to those really nice purchases in 2018, such as the first one in 2018 in May, it's a 4.2% simple yield on cost, and that's without even reinvesting the dividend. And so all the folks back then that thought, hey, PepsiCo is overvalued, hey, PepsiCo is too rich, Ian, why are you buying it here? Look, this is why the yield on cost is doing great, and this is a stable company with a stably growing dividend. And so sometimes in the moment, for example, people might have thought back in 2018, Am I too late to the game? There's going to be people filled with doubt. Oh, I missed it. I didn't buy PepsiCo early enough. And I'll tell you why. There's another metric on the screen right now. When I first started buying PepsiCo, when I first started building my position in a meaningful way, I have it boxed at the bottom of the screen. It was in 2011, and I was buying at $63. And so my yield on cost there is 6.4%, and I'm up 113% on that tranche. But there's a lot of people who thought, back in 2018, Ian, oh boy, I don't know if I want to buy it at 96 because look, you were buying it at 63. If you were buying it at 63, it can't possibly be a good buy at 96. And I think this is the biggest mistake and doubt that enters dividend investors' minds. There's so many of us that look back in time, that we look at the history, and I like looking at history. I like looking at historical records. But the problem with looking at the history is it clouds judgment, because you start seeing, wow, I bought this thing at 63. Should I really be buying it at 96? Well, fast forward today. Yeah, I should be buying at both 63 and 96, because right now we're all the way up to 136. And so on my 96 tranche from 2018, I'm up 40%. On my 63 tranche from 2011, I'm up 113%. But I'll take both of them. And so the key takeaway, again, when doubt enters the mind. Now, of course, the investor has to be smart. Of course, the investor cannot go crazy and buy overvalued, horrible opportunities. But I will tell you, in general, it is rare with a company like PepsiCo that it is a horrible decision, in my humble opinion, to buy it. Pretty much the market, as I've seen it over the years with PepsiCo, it's never been in a range for me where, oh, I just feel like it's such, looking back at it, like, wow, it was overvalued, or it was just such a bubble, if you will. Investing in a company like this, it's very different than investing in a stock like Tesla, for example. Now, no offense to the Tesla shareholders out there, but what I'm just trying to say here is having a bubble-like scenario with a company like PepsiCo, it's not as probable, it's not as likely, for example, as a high-tech stock, a stock that has gone hockey sticked, if you will, like Tesla. And so the doubt that enters the mind, the questioning that enters the mind, am I too late? Am I going to miss? Did I just miss the boat? I'm going to buy here and it's never going to go higher ever again. We know that the stock market will correct. Personally, I don't think this will be a V-shaped recovery. Personally, I think there will be another leg down in this market that may retest the March lows or go even lower. I think that is highly probable. I'm ready for it, and I will go all in when it happens. But I take comfort knowing that at any which price I am buying PepsiCo these days, when I fast forward into my future, especially looking 10 years, 20 years out, I'm going to be happy with all of the tranches. And so with all of that, I want to share some takeaways from the PepsiCo case study before I go on to StarBucks. And so I'm going to share those on the screen right now. And what you see is it's basically these findings. My current allocation is 5.58%. I want to go to 7%. 449 days went on between purchases. What the heck, Ian? What was I doing there? Why did I wait so long? What I am resolving to do with my ride or die stocks, unless I have a really good reason, if I'm under allocated, I better not let those number of days go by. And that's why I'm more focused on my top 12 favorite stocks of all time these days, because it's easier for me to focus on 12 when I'm holding myself to metrics like days elapsed. Now, something else that I want to mention is when I buy dividend stocks, as you all know, I do an exhaustive fundamental analysis. But once I'm in it, quite frankly, I don't need to re-fundamentally analyze PepsiCo every month, every week, or even every year. I need to be more focused on acquiring shares, acquiring tranches. And so what you see here is sometimes, rather than going through analysis paralysis, sometimes rather than getting fixated on valuations, it may be better just to have a recurring process and buy. Whatever price it's at, buy it on an ongoing basis. Now, certainly if I see the stock tumble and I see a good value, go a little bit heavier. But even when there's not a good value, I've already done my fundamental analysis. I know I'm in it forever. I buy and hold forever. I'm in it not only for the long term for myself, but multi-generationally as well. Sometimes it's better. And sometimes I almost think we have a smart community here. We have a community of stock analysts. We think about things very deeply. I sometimes question, does that almost put us in a worse position? Sometimes the people who are really analytical like myself, we have to think, get beyond the analysis and just act, just take action. And so that's kind of where I am these days is PepsiCo. I don't need to worry about it if it's in the 130s or 120s, 140s, drops back down to 96. Doesn't matter. Just do it. Keep buying more shares. And so also, the way I look at it these days is I'm buying future cash flow. I'm buying tranches of cash flow. And so many people, I've seen this in the dividend community, and what kind of casts a lot of doubt and what creates a lot of doubt and creates nervousness and this risk. One of the risks that dividend investors have is in a March-like scenario, cashing out, selling it all, thinking that it's going to go lower and being fearful of that. Personally, I try not to track my overall aggregate portfolio value too closely because I'm not investing for portfolio value. It's nice. It helps my ego. But the reason I'm investing is for cash flow, long-term growing tranches of cash flow. And so one of the things I have to remind myself and that I want to share with the community is when we are investing, when dividend investors are investing, why are we investing? We're investing for the streams of cash flow. And as long as PepsiCo can continue to pay and increase the dividend, it doesn't quite much matter where the stock price is. If the stock price is lower, good, because I get more cash flow for my money that I'm deploying. But if the stock price is high, I'm still buying future cash flow. I'm still buying streams of cash flow that grow over time. And all of those streams are valuable. And so it's this paradigm shift from aggregate portfolio value, from worry, from, oh, where am I in the market cycle? All of that matters, obviously, but I'm trying to present today a different perspective because there is so much doubt and concern out there. And one of the biggest risks with dividend investing, in my humble opinion, is giving up, not starting, selling stocks, cashing out, living in fear, living in doubt. All of that keeps the investor away from the long-term goal, which is really passive income cash flow, because portfolio value doesn't mean that much, but cash flow, dependable cash flow, sure does. And so I started buying this thing at 63 in 2011, but I'm still buying now in the 132 range. And so looking at the past is nice, but I've got to live in the present. I've got to look at the future as well. So a lot of lessons here from PepsiCo. I want to move on now to Starbucks. And so segment 2 here, Starbucks, check it out. I want to share it on the screen right now. So with Starbucks, I'm going to do the same thing. I want to look at my purchase history. And now keep in mind, this thing is trading at $77.24 now. It has a low 2.12% yield. I got a lot to say. But let's start with this. This is such a fun case study with the numbers. I started buying this thing this year at least in March. And I went heavy on March 2nd because if you remember, my wife and I did Frugal February. I will link in the description below. We did a fun video, joint video on Frugal February, and we saved some money. And one of the things that we did with the money we saved is we're like, hey, we saved a lot of money. How did we do it? We were drinking this. We were drinking this instead of man, this is good. I love this stuff. Oh, it's good. I'm telling you, it's Costco. Doing something right. But anyways, we saved some money drinking that instead of going to Starbucks. And we're like, hey, let's put the money in Starbucks. So put the money after Frugal February on March 2nd into Starbucks at $80.81. Okay, good enough idea. Wasn't a great deal, but like I always do, buying future streams of cash flow, buying tranches of cash flow. Already did my fundamental analysis, knew how much I love the company. Bought it at a fair price because, quite frankly, this is one I want to allocate more to as well. And it is in my top 12 as well that I shared in the last video. Lo and behold, this horrible pandemic hit, uncertainty comes, our world gets flipped upside down, and the thing tanks. And so just a few days later, in March 11th, I bought more shares at 68.08. And then on March 16th, I bought at 58.90. And then on March 18th at 51. And so literally during the month of March, most investors would feel like, wow, I've got a lot of doubt in my strategy, or I'm a horrible investor, or boy, I timed this wrong. This is embarrassing. Oh, I lost my valuable capital. It's evaporated. It's evaporated to never see it again. I don't look at it that way. I look at it that, hey, I'm buying future streams of cash flow. And so I bought some cash flow at 80 a share. Then I bought some future cash flow at 68 a share. And I was happy about that because my money goes further. 58 a share, 51 a share. And then I bought it all the way back up. You can see here on the 27th of March, 66, 31st, 67. And then I just keep buying all the way through May. As you can see, all the way through June, and now all the way through July. I bought some just Tuesday this week. I forgot to buy on Monday because I was so busy. I usually buy every Monday, but I bought at 76. And so, by the way, I'm not showing dividend reinvestment here. I'm just showing net new capital deployed. So I've been going pretty heavy in Starbucks this year, and I'm just trying to build it up. Like I said, I'm focused on my core now, my favorite stocks of all time, and I generally feel that Starbucks is a value at these prices. In the scheme of things, I'm looking at it more from a overall aggregate market cap perspective, where the company is versus where it could be 10 or 20 years from now. Based on the current metrics, the current earnings, of course, it's not a value. In fact, we'll look at that in a minute. We'll look at that because it's a critique I get all the time. But in general, I'm happy buying at these prices. Is it a screaming deal? No. Is it a fair value? Probably, but I'm looking at this through a long-term lens, and it just goes to show if it tanks again, goes back to $50 again, I will buy more. And so the first thing I just want to share with this particular example that you can see on the screen right now is it's crazy. I'm on my first tranche, I'm still down. From the $80 tranche, I'm down 4.4%. But you can see on my tranche that I bought at 51, I'm up 50% from the tranche I bought just back in March. We're only in July here. This is how wacky this market is. But you can see dollar cost averaging. This is why I do it. And something I did do well here, by the way, is I'm not letting much time elapse. The time between tranches, obviously, not much is elapsing here. So I'm doing a good job keeping a good pace with Starbucks. And one of the ways I keep the good pace is I just have a tradition. I buy it every Monday. This week I bought it Tuesday, but I just buy it every Monday. And I buy it whatever the share price is because I already did my fundamental analysis. I know in general, this isn't Tesla. This thing isn't going to get out of, it's not going to get into a bubble, if you will, too much. It's not going to go crazy in terms of the valuations. So I know it already has these guardrails on it, more or less. Whatever price I'm buying it at, when I look at it back 20, 30 years from now, it's going to be a fine price. Some are going to be better than others. But it's almost, I'm saying, taking my analysis out of it, taking my intelligence out of it a bit, if you will, and just having kind of a dumb process. Hey, I buy it every Monday. It doesn't take much to do that. It's kind of dumb. It's just kind of a recurring thing. Do it every Monday. Do it, do it, do it. I just force myself to take the action so I'm not up in my head, but I'm actually trading, making the trades, making it happen, and taking on the opportunity there to buy tranches of future cash flow. Now, what you also see on the screen right now, which is really cool, is the average share price is 72. That's just a simple average, but I'm up on my average this year. Just one of the benefits of dollar cost averaging, just buying over time, is it helped me optimize my share price so I didn't put all my money back in before everything plummeted and then potentially regret it. But even if I did, I wouldn't. But what you see on the bottom here as well is just by comparison, I was buying some Starbucks back in 2018, and I bought a tranche in March of 2018 at 55. I bought a tranche in June of 2018 at $48. And so on those tranches, I'm up 38% on the first, 60.5% on the second. So again, though, I don't let those previous tranches cloud my judgment. I try to take some of my kind of analysis paralysis out of it, if you will, and just have a system and keep going. And so I want to share now some of the findings, some of the key takeaways from this Starbucks case study with you right now. So check it out. And what you see in the findings is, again, as I already mentioned, just 16 days after buying my $80 tranche, I'm down 37%. But I bought it. I bought it at 51.22 because I've learned from past experience. Man, have I learned how to be a better investor and put the emotions aside and actually look positively towards a market drop. And then I bought some more at 76.65 this week, which is 49% higher than my lowest price that I got this year back in March, on March 18th. And so, key point here, rather than worrying too much about the news and overall market, I just keep buying. So many people get tied up in the news. President said this. Protesters are doing that. This and that. All of it matters. It's important to stay up to speed with the events that are happening in our world. But so many people let this news get to them. I try not to focus on the news too much. Once I've done my fundamental analysis, I pick the top 12 stocks of all time that I love. I try to put the news aside, and I try to move more towards a mode of just taking action. Doesn't matter what the price is, I will continue to take action, and I know that I'm mitigating my risk by buying in smaller tranches, dollar cost averaging over time. I know that I'll never sell. I know that I'm holding forever, multi-generationally. That mitigates a lot of risk. And I believe one of my core advantages that I have in the market is that I just don't care about the news. I mean, I care. Look, I don't want to seem insensitive to what's happening in the world, but from an investing standpoint, I just don't let it get to me. And quite frankly, I don't even track it that closely. And sometimes perhaps maybe I'm not as up to date on all of the current events. But I'll tell you something else. So many investors, they get caught up in the news. Oh, this happened here. This happened here. Honestly, instead of doing all of that, I could be spending my time making more money. I could be spending more time taking care of my health and going on long runs. I could be spending more time doing fun projects around the house that I enjoy doing, living my life, spending time with my wife. spending time with my family. Isn't that what's important? We all want to live our lives, and the reason we invest in dividend stocks is to receive cash flow that can be used to pay bills and eventually eliminate jobs so that we can live, and we can live free and do fun things. And when we're living free and doing fun things, I'm sure there's some people out there that truly enjoy watching the news and keeping up to date with the news. I guess I'm just not one of those people. In general, I guess I want to generally know what's going on in the world. But for me, rather than sitting down and reading the news, I would rather being out following my dreams and going on a long run, spending time with my son, with my daughter, with my wife, having family time, all that kind of good stuff. And so I want to share with you some other findings, some other takeaways from this Starbucks case study. And one of them is, I get this question literally every week. Ian, are they going to cut the dividend? They can't cover it. Why are you buying at 76? And I'll tell you why. The 2020 EPS estimate is 90 cents. And if we look at the dividend they're paying out right now, it's $1.64. 90 cents doesn't cover $1.64. Payout ratio is 182%. Now, 2021, if they hit the analyst EPS estimate of 263, the payout ratio will be fine. It'll be back at 62%. But I'll tell you, I think the EPS estimate for 2021 is a little generous. I think things are going to be bad in 2021. Like I said, I don't think this is a V-shaped recovery. I think there's going to be another bottom. I think this is going to get worse. I'm prepared for it. But people ask me, what if they cut the dividend? I don't think they will. I don't worry about that. Maybe they will. I would be shocked if they do. But even if they do, I'll just keep buying. And so I'm saying these fears. I've done a video on this. I'll link to it in the description below. My portfolio overall, I faced a few dividend cuts, but it hasn't fazed me. In fact, my dividend income, it continues to do just fine. I have a lot of companies that have aggressively raised their dividends this year throughout this horrible pandemic. And so if I have one cut here or there, that's why I diversify. That's why I have 46 stocks. But even within my top 12, I'm really well diversified. And so even if I face a dividend cut in the top 12, which I don't think would happen, I'll be fine. But it seems that this is a recurring theme, that people get caught up in this concept of there's going to be a dividend cut. And I feel it holds people back, not only from Starbucks, but from the market. They're just like, wow, I don't want to invest because there's this doubt that there could be a dividend cut. But again, look at the numbers on paper. When I look at my stock portfolio, and I'll link to that video in the description below, dividend cuts haven't fazed me at all. By the way, as I'm going through this video, please give me a thumbs up if you're enjoying the video so far. Thank you so much for your support through the likes, shares, comments, subscriptions. Means the world to me. Thank you as well for all of the generous patrons. This video is a request from one of my generous supporters on Patreon. You can support this channel for as little as $3 a month. I have over 50 patrons now. Bless you all. I want to see if I can get to 100 or even more. Thank you for your incredibly generous contributions. I am providing all my best content here on YouTube for free. No courses. None of those wacky affiliate links for this stock program where you pick up all these free stocks, this and that, mumbo jumbo. None of that. All the best content here on YouTube for free. I love you all. So continuing with Starbucks, I want to go through a few more lessons, and then I want to move in and summarize how I deal with all of the doubt and why the doubt doesn't faze me anymore, and hopefully provide a framework that could help a lot of investors who have these kind of doubts or have this challenge of dealing with past mistakes in the stock market. So let's finish up with Starbucks though first. So basically, I just don't get caught up in the short term. I don't get caught up in the short term. Earnings are bad this year. 2021, they'll probably be bad. Will they cut the dividend? Maybe they will. I don't much care. If they do, it'll be back. I'm focused on the long term. And I generally believe in the power of humans, in the power of humans over the long term. And I generally believe that society will get better over the long term. Companies will make more money. People will be happier. All that good stuff. So a few years are bad, whatever. I think these companies are dealing with the pandemic just fine. And I'll tell you, I shared this in my last video, but I got to do it again because it's a thug life moment. And I got to say it because there's so many people out there with these kind of comments, and it just, for whatever reason, I just disagree. So I got to share my perspective. And so basically I shared in my last video how my wife and I, we were enjoying an anniversary lunch, and as we were dining outdoors, they let us do that still, at least. So thank goodness. There were some younger folks walking down the street. I thought, like, wow, they all their Starbucks cups, and they're all these friends. And I'm like, wow, how old are these kids? And I thought they were like 10. My wife's like, no, they're probably like 13, teenagers. And so I thought that was cool because Starbucks is multi-generational. And one of the reasons I invest in it pretty much at any price here, because I'm pretty sure 20, 30 years from now, it's still going to be multi-generational. People still going to enjoy their coffee. It's going to put a bright spot in their day. And so, like I said, I already did the exhaustive fundamental analysis. I'm fine buying it. I don't worry about the news. I don't worry about the drama. It just keeps me on track. I'm buying future tranches of cash flow incrementally. But what was funny is someone commented on my last video, and they're like, Ian, how could you celebrate the fact that teenagers are getting addicted to these caffeinated beverages, this and that? Oh my gosh. And they almost implied like, oh, is Starbucks doing a disservice to society, getting people hooked on these so-called beverages? I'll just give you my perspective. I think, you know, just live a little. Come on. I guess that's my comment on that. It's the same as the people that hate on me for having McDonald's once in a while. Live a little. Oh my goodness. Look, I work out really, really hard. I can buy myself some McDonald's once in a while and enjoy it. But it's the same thing with Starbucks. Is think about it. What would these kids be doing without it? Perhaps to look at it from a different perspective, that they all have these beverages that that bring them together, bring their friendship circle together, have a moment with their friends, get to socialize, get them away from screen time, which could be potentially really damaging for younger people. So it gets them away from the screen, holding a beverage, enjoying some face-to-face time with their friends. Maybe the drinks that they're drinking are really delicious, and it's bringing a spark of joy into their lives that they would have never had otherwise. You know, maybe they're having just a fabulous time with their friends that they would have never had with Starbucks. So the way I look at it is, rather than Starbucks coming in and, oh my gosh, getting these kids drinking the caffeine, bad Starbucks. No, I look at it as Starbucks, you are a godsend, you are an angel coming into the lives of these young people, bringing them these delicious beverages that unite them and make their day happy. And so that's how I look at it as a thug life investor. And I love Starbucks for what they're doing, and they're doing God's work and doing an amazing mission for all generations, making everyone happy. And so I just got to vent a little with you all. So anyways, moving on. This is Thug Life Investing here. Just sharing my personal journey. I want to share a framework with all of you. So I'll check it out, share it on the screen right now. Framework with you all to close out the video today. And I have a system, and I developed this system a long time ago. And quite frankly, I don't even look at the system anymore because it's so ingrained. But I've made mistakes before. In my earlier days investing, I've been investing for over 20 years. I had doubts. I've made mistakes. I've sold at the wrong time. Well, I guess in my opinion, never really buy at the wrong time as long as you're buying quality. But I've done that stuff. And so I understand where these kind of questions come from. Doubt, mistake, loss of capital, trying to realign strategy. So I came up with a system. And the system, and I'm not saying this is the only system. I'm sharing my journey, my system. Maybe you will come up with a different system. But my thought here for the community is, if you're someone who has doubt, if you're someone who has made mistakes, if you're someone who has trouble making that first step or making that second step in the stock market or keeping it up, consider really sitting down and coming up with a system, and come up with a system like I did. It might be different than mine, that will hold you accountable. It will hold you accountable towards long-term success while still keeping you happy, safe, sane, and worry-free. And this is the system that does all of that for me. I focus on my favorite core ride or die stocks. I perform a very deep fundamental analysis, but then I kind of go on faith. Like I said, I'm buying Starbucks, PepsiCo, any which level. not too worried about it, but certainly I relish it at the times where I can get them on discount. And when they are on discount, I tend to go heavy. I keep a little extra money for that. I buy and I never sell. Honestly, never selling takes a lot of the drama out of it for me. Stock market tomorrow falls by 90%. I'm not selling. Stock market falls by 99%. I'm not selling. I should never say never. There's rare cases where I'll sell, but in general, never sell. I dollar cost average in small increments. I don't put all of my eggs in one basket, in one stock all at once. For this very reason, I dollar cost average over time. I'm always buying brick by brick, building the portfolio brick by brick by brick. Used to have the background behind me, all the bricks. But I do that and it keeps me sane. I buy tranches of future increasing cash flow. I do not buy stocks. Obviously I'm buying stocks, but I don't look at it that way. I don't look at aggregate portfolio value. I'm not looking at what's my net worth. I'm looking at literally cash flow. How much cash flow do I have now if I put more money in? How much more cash flow do I have in the future? Boy, does that keep me sane, because ultimately cash flow is what we need to live, not net worth, cash flow. And so I have a long-term belief in brighter days ahead. This one really keeps me sane, and I guess you have to see a few market downturns to kind of have this philosophy. I guess this is one of the rare cases where I agree with Warren Buffett. I know Warren Buffett is a long-term optimist on the United States American economy, I think the global economy as well. Man, Warren, I agree with you on this one. Not everything, I hope you're watching, Buffett. I hope you're watching Thug Life Investing. I don't agree with you a lot of the time, my man, but on this one I do. And by having that attitude, there's no downside to having it. And it just keeps me grounded, keeps me feeling good, keeps me aligned with my strategy. Because think about the other thing. Let's say our world is just going real bad. If it's going real bad, real fast kind of thing, honestly, there's no real way to prepare for that anyways. And so I generally am just an optimist thinking about brighter days ahead. And I'll tell you, the other thing is I've been through so many downturns. I've been through challenges in life. I'm in my late 30s. I've been through stuff. And so you gotta go through those things and you realize that these short-term hiccups always lead to better things. They always lead to better and brighter things. And you've been through it enough that you kind of have that faith that, yeah, human race, human innovation, it'll continue. It'll continue into the future. And I have a multi-generational outlook as well. Very long-term outlook. And when an outlook is that long, it is hard to lose. Now, it is possible to lose buying junk, buying yield traps. And so I have to caveat all of this that I only buy the most premium stocks. I only focus, all 46 of my stocks are ultra premium. And then the 12 that I'm really focused on now are the cream of the crop. And so for me, knowing that I have such powerful quality companies that I've done the fundamental analysis on, no matter what price I kind of buy them at, I know I'm going to do all right in the long term. And if it's not in my lifetime, it'll be multi-generational, certainly in the future, in future generations. And so that's how I do it. That's how I get rid of the doubt and all of that kind of stuff. Because I know a lot of people are feeling that with the seesaw, with the whiplash that we're facing in the stock market this year in 2020. And so before I leave today, a few things. One, shout out to my man. There's a YouTube channel called Positive Investing. Check it out. I will share in the pinned comment below a link. My homie over there, he has a really cool channel, shared a shout out in his video recently, and I wondered, like, hey, my subscribers were kind of trending way up that day. And I'm like, wow, they're coming from Positive Investing. So if you're here from Positive Investing, please put in the comments below. And let's just as a community, support Positive Investing. It's a really cool YouTube channel, really good stuff over there. Not only on dividend investing, but more, I would say, holistic stock market investing. So here on my channel, I'm mostly all about dividends. Positive Investing, you're going to find some other types of stuff there too, which I think is really cool, good complement for what I'm doing here. And so check it out. Also, I want to just let you all know, you can support me through Patreon now. I'll share a link in the description pinned comment below. Check out my merch. Available as well. Thank you for everyone who's supporting with the custom merch, representing. I love you all. Before I leave today, in terms of a full disclosure, I own the stocks mentioned today. I am long PepsiCo, ticker symbol PEP, Starbucks, ticker symbol SBUX, and McDonald's, Mickey D's, ticker symbol MCD. Shout out again to the McFlurry, eating all the junk food, all the comfort food, no problem, because I run it off. I don't do it all day, every day, but once in a while, I like to treat myself. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed investment advisor first. Literally, I'm just sharing my journey here on YouTube for fun and entertainment. And today's topic, everything just hypothetical in nature. It's a general question that I've heard from a lot of people. And so I just want to answer it hypothetically, how I address something like that. Love you all. Please hit that like button. Please do it. It means the world to me, not only on this video, but if you're watching my other videos, you really like them, don't forget to like it. That is one of the best ways you can help me out. Love you all. I'll see you in the next dividend investing video.